Disclaimer: this video is for general educational purposes only and should not be considered financial advice. Always do your own research and consider seeking professional advice before making investment decisions. When most people think about investing, they think about shares, but governments, companies, and investors around the world also use another important investment called bonds. Bonds are often considered less exciting than shares, but they play a major role in many investment portfolios. They can provide income, help reduce volatility, and offer diversification. In this video, we'll explain what bonds are, how they work, how investors make money from them, and why interest rates can have a major impact on bond prices. At its simplest, a bond is a loan. When you buy a bond, you are lending money to a government, company, or other organization. In return, they agree to pay you interest and repay the original amount at a future date. Unlike shareholders, bondholders do not own part of the organization. They are simply lenders. Let's look at a simple example. Imagine a company wants to raise $1,000. Instead of borrowing from a bank, it issues a bond. You buy that bond for $1,000. The bond pays 5% interest each year. This means you receive $50 per year in interest. At the end of the bond's term, the company repays your original $1,000. The regular interest payment from a bond is known as the coupon. The coupon is one of the main reasons investors buy bonds. Unlike shares, which may or may not pay dividends, bonds generally provide predictable income. There are two main types of bonds. Government bonds are issued by governments to fund spending and infrastructure projects. Corporate bonds are issued by companies to raise capital for business activities. Generally speaking, government bonds are considered lower risk, while corporate bonds often offer higher interest rates to compensate investors for taking additional risk. One important concept is bond maturity. Maturity is simply the date when the borrower repays the original amount invested. Some bonds mature in 1 or 2 years. Others may last 10, 20, or even 30 years. Generally, longer-term bonds are more sensitive to changes in interest rates. Many investors think bonds are completely safe. That's not always true. Like any investment, bonds carry risks. Companies can fail, governments can face financial difficulties, and bond prices can rise or fall before maturity. One of the biggest factors affecting bonds is interest rates. To understand why, let's return to our example. Imagine you own a bond paying 5% interest. Now suppose new bonds are issued paying 7% interest. Investors looking for income are likely to prefer the newer bonds. As a result, your older 5% bond becomes less attractive. Its market value may fall. This is why bond prices and interest rates typically move in opposite directions. When interest rates rise, existing bond prices often fall. When interest rates fall, existing bond prices often rise. This relationship is one of the most important concepts in bond investing. Let's look at a simple example. Imagine you own a bond paying 5% interest. If market interest rates fall to 3%, your bond suddenly becomes more attractive. New investors may be willing to pay more than the original purchase price to receive that higher income stream. This can cause the value of your bond to increase. This is one reason bonds can still generate returns, even if you never hold them until maturity. Investors can earn income through interest payments and potentially benefit from changes in bond prices. Many investors gain exposure to bonds through bond ETFs rather than buying individual bonds. Bond ETFs can hold hundreds or even thousands of bonds. This provides diversification and can make bond investing easier for beginners. Bonds are often used to help reduce portfolio volatility. During periods of uncertainty, investors may move money from shares into bonds. Because of this, bonds are often considered a defensive asset. However, they are not risk-free. As recent years have shown, rising interest rates can cause significant declines in bond prices. Let's compare bonds with some other investments. Shares offer ownership in a company and potentially higher growth. Property can provide rental income and capital growth. Cash provides stability and liquidity. Bonds sit somewhere in the middle. They typically offer income with lower volatility than shares, but usually lower long-term growth potential. Bonds can play an important role in a diversified portfolio. They provide income. They can help reduce volatility, and they often behave differently from shares during changing economic conditions. Understanding bonds is also important because interest rates influence many other assets, including shares, property, and even precious metals. A bond is essentially a loan made by an investor to a borrower. Investors earn income through interest payments. Government and corporate bonds offer different levels of risk and return. Bond prices are heavily influenced by interest rates, and for many investors, bonds remain an important tool for generating income and managing risk. If you found this video useful, please click the subscribe button. It costs you nothing but can help the channel heaps.